For many investors in this part of the world, 2023 started out optimistically, with anticipation of China's reopening after its strict zero-COVID policy. But 2 quarters later, and China's GDP growth and stock markets have underwhelmed.
What we're finding today is basically the Chinese economy, with respect to the consumers and with respect to businesses, their balance sheets are basically somewhat indebted, highly indebted, and therefore the spending is very limited from that perspective, because once you're in debt, you don't tend to spend a lot. So we're in a situation where sometimes even lower interest rates do not promote spending because individuals and companies are busy paying off debt rather than spending. So if the consumer is not spending, if the businesses are not spending, then basically you have a step down in growth. The government has to come in to basically make up the slack left behind by both the consumer and the so-called corporations. So that's what I anticipate for China.
So does that mean investors should avoid Chinese equities?
You shouldn't just say, Chinese economy not doing well, it's underwhelming, it's underperforming, and therefore I'll ignore it. I think it's too big to ignore, and we are already past the toughest stage, right? So, and if you look at the valuations, currently it's trading at 11, 12 times, not exactly expensive. Growth, obviously not there, we're talking about 4%. But where there are signs that there's an improvement, I believe the money will rush back to China. In a nutshell, really, the Chinese government will do something. It's just that it will not be to the extent of what I believe some market watchers are hoping for, right? They're hoping that there'll be widespread stimulus measures that will actually fire up everything, lock, stock, barrel. But I think it's going to be more measured.
One sector that has shown improvement in China is the property sector, which bodes well for equities across Asia too.
Real estate sales in China have rebounded. House prices are still falling, but not as fast as they were before. And of course, the debt deleveraging has slowed down for China's property developers. So that actually can be beneficial, not just for property-linked equities across Asia, but also in the fixed income space. If investors are looking at Asian high-yield corporate credit, a lot of them are linked to the property market in China. So we do see positives there. I think if we step back and look at more of the key global developments, some of the key positives for real estate investors in Asia is the prospect that we are finally converging to peak monetary policy tightness in developed markets. So that will help reduce some of the pressure on interest rates globally.
One of the brightest spots for investors keen on Asian stocks in 2023 is Japan, where strong earnings and a weak yen have made valuations appealing. But this may not continue for long as the Bank of Japan starts making some policy adjustments. The Nikkei average is trading at more than 15 times forward earnings, compared with around 12 times at the start of the year.
When we think about developed markets, our most favoured destination, of course, is the US, but close second is Japan. If we look at its growth performance, is actually slightly stronger than what we see, say, for Europe in terms of consensus expectations, and the activity data has surprised on the upside in Japan. So it's actually quite unusual this year that the consensus expects Japan's growth to be almost as strong as the US. So that's quite positive for equity investors in Japan. I guess where people have to be a bit cautious is valuations have stepped up, so you need to still be quite selective. And I think look at some of the sectors in Japan that are perhaps lagging the rebound so far. So that's some elements of consumption and also from the tradable goods sector, because even though the yen has been coming back, the real exchange rate is still quite favourable, and that could mean that the tradable sector in Japan does give good returns for equity investors going forward.
Another region of interest for investors could be Southeast Asia.
I think largely because of geopolitical reasons. US have been saying that you shouldn't be putting all the manufacturing within one zone, and we know that it is China that they are hitting very, very hard. So there's reshoring, there's friendshoring, right? And I think that the Southeast Asian countries will actually be a chief beneficiary of it. We were a major manufacturing powerhouse back in the 1990s until China basically sucked up all the manufacturing, all the FDI over there. So in terms of the facilities, in terms of the know-how, in terms of demographics, very, very important. We have a very, very young workforce and fairly driven over in this region. And I believe that once the manufacturing facilities migrate down south to Southeast Asia, it is already happening, and I think that this bodes well for Southeast Asia as a region.
But investors are also being warned to prepare for the impact of weather phenomena such as El Niño, which could send commodity prices and markets tumbling.
If the weather is very harsh in this part of Asia, we could see export bans. India most recently put an export ban on its rice. Thailand could do so, and other countries could do so. So there is a risk that the weather phenomena itself could cause basically commodity prices to go up, and that would feed into basically other prices. And central banks who thought that basically they could ease monetary policy or at least keep interest rates where they are may be forced to then raise rates unexpectedly.